My name is Stan Feldman. I'm Chief Valuation Officer of Axiom Valuation. Thank you for attending the third webinar in Axiom Symposium Education Series. The title of today's presentation is Allocation or Allocating Transaction Value Between Personal and Corporate Goodwill and Minimizing Pushback from the IRS. The interest in personal goodwill, both its establishment and its calculation, has increased significantly in the last several years. The reason is that owners of many private businesses are reaching the age where they either desire to sell or simply slow down. Much of their wealth is tied up in their businesses, and when they sell, they need to maximize the net proceeds of the sale. The distinguishing feature of these businesses is the owner plays a very significant role in the business, and the value of the business would be far less without the presence of the owner. Hence, for the business to be sold and the owner to receive full value, the personal goodwill asset associated with the owner must be transferred. The IRS position on the nature of goodwill has changed from treating personal goodwill as a form of income and not as property. Tax court cases, however, have upheld that personal goodwill is an asset and it can be transferred. The essential question then is not whether it meaning personal goodwill exists for tax purposes, but rather how to measure it when it can be established that it exists. Its existence, however, is no trivial matter. One cannot simply conclude that a sole owner, by virtue of his or her ownership, has a personal goodwill asset. Moreover, the existence of goodwill does not mean that it can be divided up in some arbitrary way. It is often conveyed to the seller of a business that the trick is to split goodwill up into its component pieces. However, this would be a mistake. In most transaction contexts, goodwill is simply described as a difference between the purchase price and the fair value of tangible assets. The difference then is split between personal and corporate goodwill. The problem with describing the nature of the exercise in this way is that it's inconsistent with how transactions are accounted for. Namely, it's inconsistent with GAAP accounting, where goodwill is an asset that is separate from other intangible assets like customer lists and trademarks. When looked at in this way, personal goodwill, although belonging to its owner, is resident in one or more of the identified intangible assets that is not corporate goodwill. Corporate goodwill, or entity goodwill, is made up of intangible assets belonging to the business and a residual GAAP, and a residual, which GAAP defines as residual goodwill, the difference between the purchase price and the fair value of the aggregation of assets purchased. Residual goodwill reflects the overpayment the buyer is making to obtain control of the firm's assets. The character of personal goodwill is separate from the character of residual goodwill. The essential difference is that personal goodwill has a finite life, like that of a customer list, while residual goodwill has an indefinite life, like a trademark. In both instances, the assets are tested for impairment and are not amortized for GAAP or book purposes. The webinar will address many of the issues I have just touched on, but certainly due to time, not all of these issues. There will be a Q&A at the end of our presentation, so I hope that each of the attendees will hold those questions until that time. However, for the webinar, for the purpose of questions, you can certainly post the questions, and once the presentation is complete, we will address the questions in the order that they were presented. Now let me take the opportunity to tell you a little about Axiom before we get into the nuts and bolts of the presentation. We are a global valuation firm doing business in North America, Middle East, Europe, and Asia. Based on our latest rankings, Axiom is in the top 10% of valuation firms in the U.S. And our business lines include valuation for financial reporting purposes, including the valuation of illiquid securities for hedge funds, intangible assets, common stock, preferred stock, derivatives, and other kinds of complicated financial assets. We also value businesses for acquisition purposes, gifting purposes, etc. Now let's turn to the next slide. Now, today's webinar will answer the following questions. How is personal goodwill defined? Under what conditions can it be transferred? What is the difference between personal and corporate goodwill? What are the benefits of establishing and valuing personal goodwill? What standards does the value of personal goodwill have to meet or minimize pushback from the IRS? How is personal goodwill defined? Number one, the asset personal goodwill must meet the definition of goodwill from a tax perspective, and it must be owned by an individual. Personal goodwill is associated with the attributes of its owner. Goodwill is defined in legislative history, regulations, and numerous court decisions. The consensus is that goodwill represents the intangible qualities that bring continued patronage from both customers and suppliers. Personal goodwill is associated with the attributes of the owner. The key is to demonstrate that the exchange between the firm and a third party will be reduced or eliminated if the owner of personal goodwill is not present. Take the case of a medical practice. The doctor involved is a plastic surgeon who is the sole owner of a cosmetic surgery practice that employs 5 other doctors. He is the face of the practice, this is no pun intended, and his patients acknowledge that they would not go to another plastic surgeon. The practice was sold to a large private hospital. A substantial part of the purchase price took the form of personal goodwill. We established personal goodwill apart from other intangible assets by selecting patients and randomly and having them fill out a survey. For privacy purposes, each patient was given a number and Axiom selected the numbers randomly. Axiom never knew the name of the patient. The results of this survey indicated the importance that the owner of the medical practice had and established for IRS purposes the existence of personal goodwill from a customer perspective. The second example relates to the creation of a supplier network. In this case, the firm in question was a marketing firm. The owner had personal relationships with window glass installers. The network was built over time and had a tremendous value. While the bulk of the network value resided with the firm, about 10% of its value was allocated to the owner, again based on a survey undertaken by Axiom. Keep in mind these intangible assets are both a net worth list and a personal goodwill. So to explain this just a bit more, the marketing firm essentially would redirect business to the installers, and the installers would replace the windows. The firm itself was a window installer firm, but it was really a marketing firm who had a network of window installers. Tax court has established guidelines for the establishment of personal goodwill. There are many cases, but both Norwalk and Martin Ice Cream provide the overall parameters. In Martin Ice Cream Company versus the Commissioner, the tax court ruled that intangible assets embodied in the shareholders' personal relationships with key suppliers and customers were not assets of the shareholders' corporation because there was no employment contract or non-competition agreement between the shareholder and the corporation. In this case, the shareholder owner, Arnold Strasberg, had developed personal relationship with his customers over a period of approximately 25 years. During this time, Mr. Strasberg was instrumental in the design of ice cream packaging and marketing techniques. In 1974, the founder of Haagen-Dazs asked Mr. Strasberg to use his ice cream marketing experience and relationships with supermarket owners and managers to introduce Haagen-Dazs ice cream products into supermarkets. The underlying question in the Martin case involved the tax treatment of the 1988 split-off of Mr. Strasberg's portion of the business from the rest of the company. Arnold Strasberg had an oral agreement to distribute Haagen-Dazs products, and his portion of the business focused on the large supermarket customers, with whom he had developed personal relationships throughout his career. Arnold Strasberg's son, Martin, the other shareholder of Martin Ice Cream, MIC for short, preferred instead to focus on the small business store or the small store business. Strasberg Ice Cream Distributors, which we call for short SIC, S-I-C, a subsidiary entirely related to Arnold Strasberg's side of the business, large supermarkets, that service a large supermarket business, was split off from the rest of the company. Arnold Strasberg became the sole shareholder of SIC, and the assets of SIC were subsequently sold to Häagen-Dazs. The tax court held that Arnold Strasberg's oral agreement for distribution with Häagen-Dazs and his personal relationships with customers were never corporate assets of MIC, M-I-C, Martin Ice Cream Company, and therefore could not have been transferred to SIC in the split-off. Now, prior to the sale to Häagen-Dazs, Arnold Strasberg was the sole owner of those intangible assets, that is, of SIC, because he had never entered into an employment or non-competition agreement. The court concluded, therefore, accordingly, neither any transfer of rights in those assets to SIC or other disposition to Häagen-Dazs is attributed to petitioner. In this case, the petitioner here is Martin Ice Cream. While the Martin Ice Cream case does not provide specific methodology for valuing personal goodwill, it does lend guidance to the issue of the identification of personal goodwill apart from corporate goodwill. Following the tax court's approach, the process of recognizing personal goodwill would consider the following issues. Do personal relationships exist between customers and suppliers and the owner-manager of the business? Do these relationships, customer or supplier, persist in the absence of formal contractual obligations? Does the owner-manager's personal reputation and or perception in the industry provide an intangible benefit to his business? Are the practices of the owner-manager innovative or distinguishable in his or her industry, such that the owner-manager is regarded as having added value to that particular industry? Now, with respect to these factors, is the owner-manager currently under any employment agreement or covenant not to compete with the business? The existence of personal goodwill apart from corporate goodwill was also recognized in Norwalk versus the Commissioner. Now, the Norwalk case centered on the tax implications of the liquidation and distribution of assets of an accounting firm, which was a C corporation. The two shareholders of the firm elected to terminate the company and to distribute the assets because the business was not profitable. The IRS maintained that the firm had realized a gain on the liquidation of its goodwill and that the shareholders had realized a capital gain from the distribution of goodwill from their accounting firm to them. Although the shareholders had employment agreements with the firm prior to the dissolution, these agreements expired at the time of the liquidation. The tax court found that the liquidation was not taxable because the employment agreements with the shareholders had expired. With no enforceable contract in place to restrict the activities of the accountants, any personal goodwill of the shareholders was not an asset belonging to the corporation. Therefore, the distribution of the client base to the shareholders did not result in a taxable event to either the firm or the shareholders. Now, citing McDonald versus the Commissioner, the tax court in Norwalk stated, "We find no authority which holds that an individual's personal ability is part of the assets of a corporation by which he's employed." Now, although both Norwalk and Martin clearly recognize the concept of personal goodwill, neither provides a definitive answer to its quantification, because personal goodwill is considered to be the value of the services of a particular individual to a firm. The issue often arises in the context of professional practices. With respect to professional practices, Lopez versus Lopez suggests several factors that should be considered in the valuation of professional goodwill. They are the age and health of the individual's demonstrated earning power, the individual's reputation in the community for judgment, skill, and knowledge, the individual's comparative professional success, the nature and duration of the professional's practice as a sole proprietor or as a contributing member of a partnership or professional corporation. Now, minimizing IRS pushback on the transfer of personal goodwill. What are these factors? Well, first, we have to demonstrate that personal goodwill exists. Second, we demonstrate that personal goodwill is owned by the transferee. A necessary and sufficient condition is no non-compete in place with the acquired firm. The idea here, of course, is if you or a manager or an owner has a non-compete with his C Corp or her C Corporation, all of the goodwill that exists is assumed to be entity goodwill. So hence, for an owner-manager, no non-compete, the personal goodwill, if it's established, therefore belongs to the owner in this particular case. There should be a purchase and sale agreement separate from the sale of corporate assets, so the buyer understands exactly that there is personal goodwill and it's being purchased. A separate non-compete in place with the buyer. So an agreement that has a separate non-compete in place with the buyer is the way the purchasing firm protects itself and makes sure that the personal goodwill of the seller is actually transferred. There should be a consulting agreement in place with acquiring firm for a period no shorter than the expected time it takes to transfer the personal goodwill. This is an important aspect of any transaction because it ensures, or it shows the IRS, for an example, that the personal goodwill assets are actually being transferred because the seller is on site, so to speak, introducing the new owners to either the customer base or the suppliers, but in any case, transferring. The consulting agreement is effectively a contract which essentially demonstrates that there is personal goodwill, it's purchased, and it's being transferred. Let's move this slide now. Yeah. Now, the difference between personal and corporate goodwill. As noted, goodwill is often referred to as the purchase price less tangible assets. This is the typical way goodwill has been described. If you went to an M&A, merger acquisition environment, this is particularly the way they would describe it. This difference is further subdivided or further divided into intangible assets owned by the enterprise and goodwill, which is split between enterprise and personal goodwill. As defined here, enterprise or corporate goodwill is subject to the impairment testing, and write-downs are netted against operating earnings in the reporting period. Now, slide 9 shows the types of intangible assets that typically are identified as part of a transaction. Note that for personal goodwill to be established, there must be a substantive non-compete agreement in place. As I said before, typically these agreements are strict and have 5-year lives. These non-compete agreements should also have a significant value associated with them. In addition, a consulting contract should be in place to ensure that the personal goodwill gets properly transferred. As I mentioned before, note that a consulting agreement is not an intangible asset. It often is referred to as one, but it's really not an intangible asset, since the seller will be providing services for a fee. Technically, if the seller is being paid below market, then the consulting agreement would give rise to the level of an intangible asset subject to amortization. But typically in a deal structure where the owner is selling the business, part of the deal price is coming in the form of a consulting agreement. But it serves the purpose here of demonstrating to the IRS that personal goodwill is being transferred. Now, what are the benefits of personal goodwill to the seller? First is a tax benefit. Since personal goodwill belongs to the seller and not the corporation, its sale is only taxed once at the individual capital gains rate. If the asset belonged to the corporation, then it would be subject to a double tax, once at the corporate capital gains rate and again when the proceeds of the sale are distributed. Marital dissolution Although personal goodwill belongs to the individual, it still may be subject to matrimonial division. 24 states and the District of Columbia exclude personal goodwill from the marital estate. 19 states, Arizona among them, include personal goodwill in the marital estate, and 8 states have no formal precedent. Personal goodwill is not subject to the selling corporation's creditors. Now let us now look at the size of the tax saving associated with allocating transaction value to personal goodwill. Slides 11 and 12 offer examples of the tax savings that emerge if an asset sale includes a sale of personal goodwill. So this slide, slide 11, shows a stock sale. The transaction price is $10,000, but can just as easily be $10 million. A stock sale will always be the most efficient way for the seller to structure a transaction. It will also be the most expensive way for the buyer to acquire the firm. Why? Basis in stock is typically much larger than the basis in assets. When a change in control occurs, the acquirer does not get the write-up of the assets and take advantage of tax amortization benefit. Also, by acquiring assets rather than stock, the buyer is not purchasing any current and future liabilities associated with the ownership of the firm's stock. Based on the exhibit in slide 11, the effective tax rate is 15%. This, of course, is likely to be much higher in 2013 and beyond, but for this purpose, it's 15%. Turning to slide 12, we can compare an asset deal with and without personal goodwill. Now, comparing the effective tax rates with and without personal goodwill allocation, one can see that the effective tax rate is 15 percentage points lower when a percentage of the transaction price is allocated to personal goodwill. While tax rates will certainly increase in 2013, a personal goodwill allocation will continue to offer protection from double taxation. While there are obvious tax benefits for the seller, what are the tax benefits for the acquirer? Now, before we kind of move on to that, we should notice what the tax rate differences look like. So, for an example, in a straight asset sale, the effective tax rate for the seller is 45%. The effective tax rate for the in the case of personal goodwill, and in this case, the $10,000 is split up between $5,000 in corporate assets and $5,000 in personal goodwill. Now, clearly, the larger the percentage of the transaction price as personal goodwill, the lower the effective tax rate on the transaction. The issue is one of the issues is what is the highest percentage one can reasonably take without getting pushback from the IRS, which is a question we'll address in a few minutes. But for the moment, let's take a look at what the tax benefits are to the acquirer. Now, the tax benefit, or the chief tax benefit to the acquirer, is that the acquirer can amortize the fair value of all intangible assets purchased, including personal goodwill, over 15 years. Now, the 15-year amortization period is for tax purposes. It's not for book purposes, but for tax purposes, which is really the important amortization period, is 15 years. It is not necessary for the parties to a transaction to make a 338 election, treatment of a stock deal as if it were an asset sale, to take advantage of the tax benefits of personal goodwill. So, again, we don't have to do a 338 election. One can, as I said, it's not necessary for the parties to the transaction to make a 338 election, treatment of a stock deal as if it were an asset deal, to take advantage of the tax benefits of personal goodwill. In a stock transaction where an owner purchases the stock of the company and then purchases the personal goodwill of one or more of the key sellers, this personal goodwill is an intangible asset and hence can be amortized over 15 years. The point being here is that personal goodwill can get sold. It can get sold in a stock deal where the stock is purchased for X number of dollars, and then the personal goodwill can be sold for Y dollars. Personal goodwill is property. It belongs to a person. It can be transacted. It can be acquired. Now let's move on to slide 14. and review the criteria for minimizing IRS pushback on the value of personal goodwill. Now, the one question that is always asked with any of our clients for which we're doing a personal goodwill valuation, is there a critical limit on the percentage of the transaction price that is allocated to personal goodwill above which will trigger the IRS comment letter? So let me stop here just for a moment. Now, if one looks at the history of personal goodwill and the valuation of it, probably the number of personal goodwill valuations historically is not necessarily going to be a good guide for the number of personal goodwill valuations going forward. And the reason for that simply has to do with baby boomers retiring, selling their businesses, and wanting to minimize taxes and taxes in the transaction. So that you could expect the IRS to be overwhelmed in many ways with personal goodwill valuations. So what they're beginning to do is think about how to structure the way they look at these to identify the ones that appear to be appropriate and the ones that are not. Now, so let me ask the question again. Is there a critical limit on the percentage of the transaction price that is allocated to personal goodwill, above which will trigger an IRS comment letter? Now, generally, I'm not aware of such a limit. Facts and circumstances always dictate what a reasonable percentage is. However, there are certain subjective guidelines I noted earlier and are associated with tax court cases. While tax court decisions provide some overall guidance, one should not over-rely on these since they are so fact and circumstance-based. The real question to ask is, does the personal goodwill allocation make sense, and is it based on known facts and not a set of assumptions that do not flow from the character and nature of the business and person to which the attributes of personal goodwill are attached? Therefore, how does one judge reasonableness of the personal goodwill allocation? There are 6 criteria shown in slide 14. These criteria assume that the basis of personal goodwill has already been established. The first is personal goodwill must be fair valued along with other purchased assets. Personal goodwill cannot be calculated apart from other identified assets because in general it is embodied in one or more of these assets. The issue is to separate its value, that is personal goodwill, from the value of other assets. Therefore, the standard of reasonableness implies that the value of the other assets purchased are also reasonable in light of the facts and circumstances. The second criteria relates to cash flows. As we will show shortly, the cash flows allocated to each acquired asset determines its fair value. The cash flows are not arbitrary, but should be the cash flows that underlie any acquisition, any deal. In many cases, the acquirer will not share this analysis with the seller. Often personal goodwill allocations are done prior to the actual transaction date, and that probably happens more often than not. Thus, in order to do this properly, namely to identify the cash flows properly and to value personal goodwill properly, the cash flows that are to be used in the analysis should be those that an informed market participant would use. The third criterion is that the aggregate of the fair value of assets purchased, including personal goodwill, should not exceed the purchase price. That is the purchase price of the deal, how much the buyer is paying for the business. The reason for this condition is that a bargain purchase is generally inconsistent with personal goodwill. Put differently, if personal goodwill is so valuable, why would the seller agree to a bargain purchase? This is not to say there are conditions under which this might occur, but as a general rule, there's a logical disconnect between these two concepts. Also, when this occurs, the IRS may expect that the value assigned to personal goodwill is overstated. That is to say, if it appears that the analysis demonstrates a bargain purchase, and personal goodwill is a very large percentage of the transaction price, then the IRS will default to somewhere there's a disconnect, and it's likely that personal goodwill is probably overstated, and you will get an IRS comment letter. Points 4 and 5 go to the reasonableness of the analysis. As we show later, the analysis requires that rates of return are assigned to each of the intangible assets. These rates are the required rate of return associated with each asset that reflects its relative riskiness and hence the return an informed investor would expect if the investor was to acquire the asset in question. The IRR associated, or the internal rate of return associated with the investment, should be in line with the cost of capital. However, if the IRR, or the internal rate of return, is too high relative to the weighted average cost of capital, or the WACC as we refer to it, it does imply that the cash flows are higher than a market participant likely assume, and therefore may imply that one or more of the assets is not properly valued. The likelihood is that the asset that's not properly valued would likely be personal goodwill. Finally, point 6 is simply an implication associated with the other points. Namely, the value of personal goodwill should be in line with the value of other acquired assets. Now let us move to a case study which deals with a consulting firm. This is a client of Axiom's, and this is a reasonably, a very successful consulting firm. And the seller was selling the consulting practice. So let's review the facts and circumstances for this particular case. The founder started the consulting practice, which was a C corporation 20 years ago. Now, just as background, the intent of the seller at some point was to raise outside money, which never actually happened. And the reason why that was important is when he started the business, it's always easier to raise outside money if you're a C corporation rather than any other corporate form, and he never changed it. That's typically what that's what happened to this particular individual, and that's typically the case. The practice has two streams of revenue. Let's call one stream of revenue traditional consulting, and the other stream of revenue what we call research-based consulting. And in this particular case, the owner and the founder, she was spent most of her time focusing in on the research-based consulting, not the what we'll call traditional consulting. The research-based consulting had a special she had a special relationship with the client base there, and she retained that throughout her ownership of the company. The traditional consulting was carried on by senior executives in the company, but she was not particularly heavily involved, I should say. Now, the customer base for each business segment is slightly different. Customers are located all over the world and are well-known and predominantly public companies. So the customer base was large public companies for the most part, for both the consulting and the research-based consulting. Now, over the years, the founder has been contacted numerous times about potentially selling the business, but for a variety of reasons, she decided not to sell. The acquirer purchased the assets of the corporation and the personal goodwill of the founder. Okay. Now, slide 17 shows the indicators that help establish personal goodwill. The X indicates the characteristics of the seller as it relates to helping establish the existence of her personal goodwill. So this is a chart that appeared in our report. It was essentially there, as I noted here, to provide the character, if you wish, or the characteristics of the business and the role the owner played. Now, the top half of the table indicates that if there is a limited formal organizational structure, personal service is a key component to the value delivered to customers, and the owner is central to the relationship, then there's a high probability that personal goodwill exists. This does not mean that personal goodwill does not exist for larger firms with multiple owners, but rather that the likelihood is that this does not mean that personal goodwill does not exist for larger firms with multiple owners, but rather the likelihood is that it does exist in this context becomes smaller the larger and more formal the organization structure. The concept here is that firms with formal business organization structures generally force the unintended transfer of personal goodwill to the entity. Hence, the customers, for example, are less likely to associate with the person and more so identify with the firm. In the end, the existence of personal goodwill is fact and circumstance-based. The deal structure requirements for personal goodwill have already been discussed, but it pays to repeat them. The buyer has insisted on and bargained for a separate personal corporate non-compete agreement or employment agreement. There's a separately bargained for agreement to purchase personal goodwill. Now, in both of these cases, that was in this particular case, both of these were true. Personal seller financing is part of the consideration. It was not part in this case. It was an all-cash deal. An earn-out is part of the consideration. It was not. It was, again, as I said, an all-cash deal. And there was a strategic buyer's acquisition premium. The premium that was determined, as you'll see, is essentially the personal goodwill of the seller. Now, as slide 18 shows, personal goodwill, row 14, represents about 25% of the purchase price. So if we look at this table, it's pretty, lots of numbers and lots of concepts. But essentially, in the transaction that occurred, the table that you see in front of you, those are the assets that I've identified there are the assets that were actually purchased by the buyer. They were each of the assets, both current assets, that is current assets excluding cash, and cash and marketable securities. The cash and marketable securities represented what was necessary for the buyer to have in place to continue the operation after the change in control. Net fixed assets were generally very, very small here, basically desks and computers. And the rest, as you can see, are completely intangible assets. Now, these intangible assets include brand names. There was a report library. Basically, all the research that was done was categorized, held in a library, and actually had a value because the research had a shelf life, which was actually pretty long, as it turns out, and pretty valuable as a result. And, of course, there were non-compete agreements. There were customer relationships. If you go to look at row 10, that customer relationship, which is for consulting and research, that's the customer relationship that the entity owned. That is to say, the value of the relationships that they own in this particular transaction. Personal goodwill, in this case, is about 1.4, a little over 1.4 million, and represent about 25% of the transaction value. Now, the actual numbers you see here, the numbers that you see here aren't really the actual numbers of the transaction. They were somewhat different. But in general, the numbers you see are reflective of the numbers that actually showed up in the report we wrote for the client. Now, as I said, there are other assets, while not as valuable individually as personal goodwill, are nevertheless very valuable collectively. The tax amortization benefit, row 18, is the value associated with the amortization of intangible assets. Now, the idea here is that the seller understands that the asset's going to be amortized, and that has a value, and some of that value is actually going to be purchased, if you will, by the acquirer. Also note that the analysis includes the value of the workforce, and while it is not an intangible asset for this purpose, it does need to be valued and a contributory charge taken against it before cash flows can be properly allocated to each of the identified assets. Now, we have not mentioned contributory charges to this point, and perhaps now it is time to do so. Assume for the moment that after-tax cash flow for the company is $100, and the firm in question has one intangible asset and a workforce valued at $100. Now, since the workforce is a corporate asset, one would expect the contributory charge to be equal to its WACC, weighted average cost of capital, say 10%, multiplied by the value of the workforce. Thus, the contributory charge against the workforce is $10, or 100 times 10%. The value then allocated to the intangible asset is now $90, $100 of after-tax cash flow less the $10 contributory charge. The point here is that all purchase assets have a contributory charge that must be accounted for if the cash flows are properly allocated to assets in general and intangible assets in particular. Slide 19 shows the calculation of personal goodwill. And we'll spend a little time on this particular slide. We are now prepared to review the calculation of personal goodwill. Step 1 shows the customer loss rates for this firm. So let me stop just for a second and just overview what we're going to do here, and then spend more time, give a more detailed explanation. Essentially, the personal goodwill in this particular case emanates from the customer base. The customer base was critical to, was there predominantly because of the owner of the company. And what happened in this particular case is that the customer base, as part of the process, without explaining the research component too much, essentially the customer base actually provided data to the firm. That data was then processed, and what was given back was let's call it research output. Now, much of the data was proprietary, and as a result of this, firms that were participating in this were very leery about sharing that data with anybody else except the founder. And the reason that was the case is that the business was started on this basis. So the founder became very, very critical to the transfer of information, its processing, and the subsequent sale back to the customer base. Now, so the raw data was supplied. The raw data that we used here was supplied by the client. Now, we calculated the loss rates or client turnover for both revenue segments. The loss rates with the owner in place are 31% for consulting and 5% for research. So let me stop here for a minute. For those of you that aren't familiar with this kind of data, and we tell our clients all the time that one of the things you should do in their business is to keep track of your clients and the turnover. You know, that is when you lose them and when you get them back. Turnover is very, very important. So, for example, the higher the turnover of your client base, the less valuable the customer list. That's just kind of almost axiomatic. So what we want to do here is we went to the client and got historical loss rate information. And it's pretty clear from these loss rates that if you look at consulting is a very high loss rate, 31%. That's basically, if you think of that, it's a life of a customer list of rough numbers 3 years, a little less than 3 years. For research, the actual loss rates here with the owner in place is far less for research than it is for consulting. And the reason it is because the owner plays such a strong role in with the research client base. Again, this is all data based coming from the company, which can be shared with the IRS if, in fact, they ever ask questions about this. Now, from the basic data, we calculate the loss rates or client turnover for both revenue segments. The loss rates with the owner in place, as I said, are 31% for consulting and actually 5% for research. Now, based on other information, we concluded that going forward, the loss rate would be higher than the 5%. Based on Axiom's analysis, we concluded that the research loss rate would average about 7.75% going forward with the presence of the owner. So what we concluded there is that while the historical loss rate was very low, it may be it's likely to be somewhat higher based on our experience and other factors that affect the performance of this particular company. And 7.75%, again, based on these other factors, what was actually used in the analysis. The question here is, what would the loss rate be if the owner was not available to transfer his personal goodwill? Now, this data indicates that it would not likely be higher than 31%, because the owner was, if the owner is not not available, it's not likely to be higher. And why do we know that? Well, we know that because in the consulting part of their business, the owner didn't play a very large role, and the result of that, or part of the result of that, was the loss rates were much higher. The loss rate here, that is for research, was established by finding the rate. Now this is again. Let me stop here for a minute. So what do we want to know? We want to know how do we go from 7.75% to 25%? Was that number just kind of came out of the air? Well, if you bear with me for a minute or so, you'll see how this works. But let me explain the method we used, and then show you the results. That loss rate, the 25%, was established by finding the rate no higher than 31% that would yield a rate of return on residual goodwill that was higher than the firm's cost of equity. Okay? Now, this is the critical factor, and the reason it's a critical factor here is because residual goodwill, that is what's left over after all the assets are being accounted for, what is left over. Think of it as the overpayment. That the return on that overpayment should always be higher than the return on all the other assets that are purchased in the transaction. So now this was the criterion, as I said, because residual goodwill is more risky than other intangible assets. What is really critical here is that the value of personal goodwill is not assumption driven, but driven by both the firm's internal data and the structure of the deal. A red flag for the IRS is when personal goodwill is predominantly assumption-driven. If you look at the cases, Martin Eiskin case is the best example, as a good example, is that there was a tremendous amount of assumption in that particular case, as opposed to hard data. And then when it did go to tax court, that hard data came out, and of course, Mrs. Strasberg won the case. Now, slide 20 shows what we call the economic balance sheet. The economic balance sheet on the asset side is equivalent to enterprise value. Now, so again, this is again what I call is the economic balance sheet, and the economic balance sheet is to be distinguished from what I'll call the accounting balance sheet. Now, this economic balance sheet differs from the accounting balance sheet in that current operating assets are replaced by working capital, current operating assets less current operating liabilities. Note that each asset is assigned a rate of return. The assigned rates are those used to calculate the value of the intangible assets. The rates assigned to intangible assets are based on the relative riskiness of these assets. Column C shows the source of these rates. The cost of equity and the WACC, the weighted average cost of capital, were developed using a modified CAPM framework. Now, the fair value of the asset side of the balance sheet must be equal to the fair value of equity and debt used to finance the asset base. This implies that the weighted average return on assets must equal the weighted average cost of capital. Since we know the WACC, the rates associated with each asset except residual goodwill, and the share of the purchase allocated to each asset as shown in column B, we can now solve the economic balance sheet equality for the return on residual goodwill. The result is that the residual goodwill return exceeds the cost of equity, which implies that the value of personal goodwill is consistent with the fair value of assets acquired and the overall deal structure. Let's go back to slide 19. Now, given what I've just said, let's go back and take a look at what we did here in step 2. So basically, in step 2, what we did is we valued the customer list with the owner based on expected cash flows from the corporation, taking account of all the contributory charges for all the other assets. We then went ahead and revalued the customer list without the owner, assuming now a 25% loss rate. Personal goodwill in this case is $1.4 million. It's simply the difference between the two. Now the question now becomes, is the $1.4 million a reasonable estimate of personal goodwill given all the characteristics of the deal and the deal structure. So let's go now back to slide 20. And what are the characteristics? Well, here are all the assets. If you look at the left-hand side of the economic balance sheet, you've got dollar values and rates of return, right? And what we want to know, and you also have the rate of return on personal goodwill, which is essentially it has a lower rate of return, let's say, than the rate of return on actually the customer list, both research and consulting, that's owned by the entity itself, as opposed to the personal goodwill of the seller. And why is the return less? Well, the return's less because it's far less risky. He's got, or she, in this case, she's got a very tight relationship with that research client base. So when you go through the deal price, the cash flows, and what you find is that there is some residual goodwill. What should the rate of return be? Right? The rate of return here is a little over 23%. Which is higher than the returns on all the other assets, implying that that the establishment of value and the rates of returns associated with it are likely to be accurate, and the allocation of cash flows to the various assets, which give us the asset values, are appropriate. Now, finally, this slide shows the IRR calculation, and essentially the IRR calculation is basically higher than the weighted average cost of capital, but the difference is not material. That is, it's a little less than 6%, but it's not material. That is, these kinds of differences can emerge in a situation like this. Now, also keep in mind that the seller is entering into a consulting agreement, which is not an intangible asset for this purpose, for which the added cost, which is an added cost to the deal, which would better align the IRR with the weighted average cost of capital. And of course, in the report, that is noted, and a residual calculation, shall we say, is done, which incorporates that, which aligns these two rates, essentially makes them closer together. It doesn't look like the IRR and the WACC are inconsistent. Now, what might the IRS pushback be, or pushback on in this analysis? Well, I would say not much. And why? Because the service would have to demonstrate that either the math is wrong or the data is somehow compromised. In short, by demonstrating an in-depth analysis has been done based on hard data, the less likely the service will give pushback. Okay. If I go to the next slide, this is, I won't spend any time on this. This is essentially the cost of capital calculations that are done. This is kind of what I'll call standard in the valuation world. So let me give you some final thoughts, and then we can open up the, and then we'll move to Q&A. Personal goodwill cannot be calculated separately from the value of other assets purchased. Personal goodwill cannot be calculated from the value of the other assets purchased. There will be IRS pushback if the split between personal and corporate goodwill is seen as arbitrary. Why? Because the buyer has no skin in the game. And personal goodwill typically emanates from one of three sources: customer relationships, supplier relationships, special skills or talents of the person or persons in question. That's the end of our presentation. And now let me try to address some of the questions that are here. There's one question: you get a copy of the presentation. The answer is yes. There'll be one available. I think we can send it. We'll email it to you, so you don't have to go and go to our website and download it. So let's see what other questions there are. Okay. One question that we have is, from our perspective, what is the takeaway that one should? I mean, what's the takeaway in terms of what happens if the customer, that the personal goodwill is not embedded in with customers, but embedded someplace else. Maybe it's embedded in all the other intangible assets. How do we get that out? Well, in other words, how do we separate the personal goodwill from where it resides? I think the best way to answer this is for each of the assets in question, and usually intangible assets in question, one has to specify what form the personal goodwill takes. An example might be if you're looking at KFC and you see the picture of Colonel Sanders. That picture actually has a value, and there might be, if Colonel Sanders owned that picture, that would be an example of his personal goodwill. So in other words, it doesn't necessarily take the form of a customer base. It could take the form of an identification, if you will, kind of more of a trademark than it would be a customer base. Supplier networks are also very important aspects which we haven't dealt with here, and we've done a number of cases where actually the personal goodwill actually shows up in the form of a supplier network and not necessarily a customer base. But I think in general the point of all of this is that the IRS will give lots of pushback if the analysis that's done, if there's no analysis done, that is to say, or little analysis done, that if in fact most of the work is assumption-based, it's not data-driven. So the key items, I think, to take away to actually respond more directly to the question is you need lots of data to demonstrate first you have to establish that goodwill, in fact, exists, that the owner of the business is the one that actually possesses it, and it's got to be data-based. You simply can't assert it and then go ahead and calculate your assertion. And the more of that that's demonstrated, the more of that goes on in a report or is demonstrated in a report, the more likely that the IRS will give lots of pushback. Well, I appreciate everybody's time today. I know it's very, very valuable. This is the third webinar that Axiom has put on. This is by far and away we have the largest attendee list here. So I wanted to thank all of the participants in today's webinar for attending. As I said, this is the third webinar in Axiom Valuation's Educational Symposium series. These webinars are held once per quarter, and just for the record, the attendees, like I said, at today's webinar is by far the largest to date. Please contact us with valuation topics you'd like to see discussed. Again, thank you for attending, and from each of us at Axiom, have a happy and very healthy holiday.